Canada's real estate market is going to experience a long, slow grind in 2026, according to BMO's chief economist, who I'm going to talk to today on the channel. I'm excited to bring you a little bit of a special episode today. I haven't posted a podcast on the YouTube channel in a while because we actually have a YouTube channel for the podcast now, which is the Canadian Investor Podcast Network. I'll collab them on this video, so you can just like hit the subscribe button if you're interested in that channel. It's both the Canadian Investor Podcast Show and the Canadian Real Estate Investor Podcast Show. So you'll get episodes from two of the top investing shows in Canada on that channel. And part of having that platform is like corporate and like the government, policymakers, et cetera, kind of reluctant if you approach them to like do like an interview on a YouTube channel. Although I think it's warming up a lot, and I have a couple of sweet interviews coming up on the channel, and I've done a couple so far. But for like podcasts, I think you can get a lot better guests. At least this is what I've seen so far in Canada. And so it allows us to get really cool people like Rob Kavcic, who is the senior economist at BMO, who, in my view, has called the Canadian housing market the best out of any of the big six bank economists. No disrespect to any of the other ones, because I think they're all pretty exceptional on other files, but I think Rob's been really great. I think Rob and National Bank, probably, in their housing affordability monitor, have been the two who have called Canadian real estate the best. And so I wanted to just post this full episode. It's myself and my co-host Nick, who's my co-host on the Canadian Real Estate Investor Podcast, which is Canada's #1 real estate podcast. And so we sort of do like a briefing. We go through an article that prompted us to reach out to Rob, which was that Canada's real estate market is going to experience a long, slow grind through 2026. And so we discuss that and we get into his thoughts. Anyway, I don't want to get in too deep on this because it's going to be a really long episode, but it's a good one, and I hope you can watch it all the way till the end. And I really appreciate it if you're interested in real estate and my commentary on stuff. If you can either subscribe to the Canadian Real Estate Investor and Canadian Investor YouTube channel, and or our podcast platform on whatever platform you use. So like Apple, Spotify, we're on everything pretty much. And I'll put as many of the links in there as I can in the show notes. We are diving into one of the most pressing questions for Canadian homeowners and buyers, which is what's next for the real estate market in Canada.
Yeah, that is a loaded question, because after years of turbulence, from record-breaking prices back in the craziness of 2022 to the significant corrections that we've all been living through, many of you are wondering if 2026 will be the year that we finally see some normalcy and maybe even some relief in the real estate market. Well, according to BMO senior economist and friend of the show, Robert Kavcic, the answer is complicated. He's forecasting what he calls a long and slow grind. Dan, I feel like we've said something similar on the show for years now. It sounds like Rob is saying the same thing, just more eloquently. And that long and slow grind is going to be towards affordability, where he expects prices to decline even more before we see things start to stabilize a little.
Since early 2022, prices across Canada have fallen about 17% from their peak, but affordability remains out of reach for many. So people aren't able to re-enter the market despite prices getting better. The Greater Toronto Area has seen detached house prices drop 8% year over year, while condos fell 3.8%. Meanwhile, investors who once fueled the market boom have abandoned ship, calling real estate dead money compared to the soaring equity markets.
Ouch, that hurts. Look, today we're going to explore why Rob Kavcic believes prices may have further to fall, and what's happening in the rental market, and what this all means for buyers and sellers and investors that are trying to navigate 2026. And then we're lucky enough that in the second half of our show, we're actually going to be joined by Rob himself to do a bit of a deeper dive into his forecast.
So let's open up with this great article from the Globe and Mail, which features Rob, titled "BMO Economist Says Real Estate Has Entered a Slow Grind Towards Affordability." It says across Canada, people who want to sell their houses and people who want to buy homes are wondering if 2026 will work out for them. Sellers want to know if home prices will go back up. Buyers want to know if home prices will keep dropping. Robert Kavcic, an economist at the Bank of Montreal, thinks buyers have the advantage right now. Mr. Kavcic suggests that a long and slow grind towards becoming affordable, and he doesn't see anything that will change this quickly. And we've had Rob on the show talking about this a couple of times in the past. I think he's coming up on maybe one of our most repeated guests.
Wow, what an honor.
Yeah, home prices have dropped from their highest point and interest rates have come down, but buying a house is still too expensive for many buyers, says the Economist, and people's incomes need to go up to match housing costs, and that takes time.
Yeah, Dan, what we've said, right? There's got to be either house prices come down or incomes go up, and the delta between what has to happen there is huge. And I think everyone would like their income to go up, but if your income goes up and everything gets more expensive at the same time, it's kind of still the same problem. So let's take a quick pause here and get a refresher on just what a buyer's versus seller's market is. Look, real estate and the housing market, like every market, are cyclical. We've been covering those cycles since day one on the show. In fact, if you go all the way back and listen to our second episode, we talk all about every real estate cycle that we've had in Canadian history, every recession, and kind of what real estate did within that time period. So go back and check that out. But look, a real estate cycle can be influenced by a number of different factors, many of which we've seen very actively over the past little while. Interest rates, economic conditions, consumer confidence being a huge one, and of course, larger geopolitical strains that kind of just have an effect on that sentiment. And that can create a shortage or a surplus in housing. A seller's market is when there's a shortage in housing or potential more buyers than there are homes. And a buyer's market, on the other hand, is the opposite. It occurs when there's a surplus in housing or more homes than there are buyers. And of course, a balanced market, which is what we're all hoping to get back to at some point, is when there are equal numbers and the real estate market just kind of works like it should. Dan, give me a couple quick points for everyone to remind them on what a seller's and buyer's market look like.
Yeah, and I think it's important to note, and we cover this when we do our CREA stats, and BMO actually probably does one of the best representations of it, so I'll often bring that chart up where they basically show the sales to new listings ratio and months of inventory in different markets across the country, because by no means is the entire country in a buyer's market or a seller's market. It really varies on a city-by-city basis, and a lot of the more affordable markets would be in seller's markets, and a lot of the less affordable markets, like Toronto and Vancouver, would be in buyer's markets. So what does that actually mean? Well, a seller's market is more buyers than homes for sale. Prices tend to be higher because of increased demand. Homes sell quickly. You usually will see upward price discovery. So, prices tend to increase in this type of environment. And you're more likely to see, maybe multiple offers, bidding wars gives the seller a bit of a negotiating power because there's a scarcity of listings and there's more buyers than there are homes for sale. And conditional offers are often rejected in these types of markets. A seller's market is a difficult market for a real estate investor. And a lot of people are learning that the hard way, maybe over the last couple of years.
Yeah.
The biggest benefit that they might get is that they get that price increase as an investor, but it's really hard to find yield or like cash flow, like real intrinsic investment value in a seller's market. In a buyer's market, there's more homes on the market than buyers. So you have a excess supply. Prices tend to be lower because of this increased supply, and prices tend to be trending down as a result of buyers having the negotiating power and sellers having to come down to their price to meet them there, and then prices will come down accordingly. And homes are more likely to sit unsold, which we're seeing right now, a lot of unsold inventory, a lot of people canceling listings. Housing surplus can now slow rising prices and even lead to price reductions. And buyers have more choices and more leverage to negotiate in this type of market.
Yeah, I mean, look, very different territories and very different behavior depending on who you are and what you're trying to accomplish should be had and should be acted upon in those markets. Now, Dan, you mentioned a key piece there, right? Investors. Well, obviously, this is the Canadian Real Estate Investor Podcast, so we're going to talk about what this means for those of you who invest in real estate, because investors had previously played a significant role in driving the dramatic surge in real estate prices, and in a lot of ways now have either completely exited the market or are sitting on those very full sidelines we've been talking about for years. And there appears to be very little reason or motivation for them to consider returning anytime soon, right? I mean, we've seen prices go up. We've seen cap rates disappear. We've seen cash flow disappear. The price per square foot has gone up. All the numbers kind of from an investor standpoint seem to be moving in the wrong direction, at least, and again, here's the caveat, at least in some major markets and in certain asset classes. Now, Kavcic says he started calling this back in 2022. Well, So did we. He said they would take years, not just months or quarters, to unwind all the excessive froth and speculation that had been built up in the market. And, Dan, I think we were directly in line with Rob's call back then. Kind of,
I think we
saw
had
the
him
writing
on
on
the
the
show
wall
at that point, right? Yeah. Like, I was sort of talking to him when I was doing interviews for Better Dwelling during that period of time as well, and he really, sort of helped to form a lot of my perspective on the market, and I think he's probably been the most accurate on his calls on the real estate market out of all of the big six banks economists. So at a time when Mr. Kavcic made his initial prediction about the long-term nature of the correction, interest rates had fallen to levels below the rate of inflation. Speculative activity in the real estate sector was widespread and enthusiastic, and demographic patterns across the country were beginning to undergo significant shifts, a la, massive population growth that even lasted into 2023, right?
Mm-hmm, mm-hmm. And look, in those years, and since that time has passed, prices across the broader Canadian market, right? We're not talking about just the usual suspects here, but prices across most markets have fallen. And that's about 17% from their peak levels that were reached back in the craziness of 2022, with some areas and specific price brackets experiencing even more substantial and severe price declines, right? These are the kind of crazier markets, some stuff in the GTA, some stuff in the lower mainland that shot up a ridiculous amount. Investing was not the word for that kind of behavior. It was pure speculation mixed with greed, mixed with opportunism that really drove those markets to hit double-digit appreciation in months in some cases.
Yeah. And now at the start of 2026, the Bank of Canada's benchmark rate is in the neutral range. Investors have fled the market, and maybe some are still going into your CMHC, MLI Select stuff, but that's not really going to show up on your single family home price in at a national level. Federal government has restricted surging immigration, and millennials are moving past their peak home buying age, and you also have the renewal wall happening, right? So
yeah, it's a series of unfortunate events. And Dan, you mentioned the peak home buying age. Well, look, the average age of a first-time home buyer in Canada now is approximately 36 years old. And that's a significant increase from, previous decades. And that's all due to, guess what? Rising home prices, affordability challenges, employment, and a whole gambit of other things that contribute to, that age getting pushed up. And that's just the average. It's actually even worse in, Ontario, specifically GTA, and of course Vancouver, Lower Mainland, where the average age is either 40 or creeping above 40 years old now. And again, if you go back 20, 30 years, you can shave anywhere from 5 to 10 years off of that number.
And across the country, prices have been stable in many cities since the spring, Mr. Kavcic points out, but he believes they have further to fall. And I have, for those of you who follow us on YouTube, and are on our Patreon stream, which you can get a ad-free version of the show as well as full video versions of the show on our Patreon for $9 a month. I have the market balance by region here, which shows which markets are in buyers markets and which markets are in sellers market. And this is Rob's analysis that they put up from the Canadian Real Estate Association stats on the BMO Economics website on a monthly basis. And the national heavyweight, the Greater Toronto Area, saw the average price of a detached home fall 8% in November from the same month last year, while the average price of a condo apartment dropped about 3.8% in the same period. And Toronto is definitely in one of the deepest buyers markets in the country based on their analysis.
Yeah, and buyers are watching those prices drop in real time. They're facing a tough choice: buy now and risk the asset or the home I just paid for, risk that price falling even more, or do I, go join everyone on those sidelines and wait and potentially risk prices going back up? It's kind of, stuck between a rock and a hard place. There's a big gap between what sellers want and what buyers are willing to pay right now. The longer this goes on, the more sellers will give in, and sellers are more likely to lower their prices than buyers are to pay more, especially in today's market.
And taking a high-level view, Mr. Kavcic notes that the supply of the 3 or 4 bedroom houses with a backyard that many families want remains tight across Canada, but especially in the GTA. And we're not building more of these, right? And developers have really flooded the market with more condo and apartment supply, and that continues to grow as a result of programs like CMHC, MLI Select. So we've had a relatively limited inventory of single-family homes, which has sort of helped to soften the downtrend in prices there. But buyers still struggle a lot with affordability. So there's not a lot of buyers who can afford all those single-family homes. The condo segment in Toronto and other cities in southern Ontario is likely to see further price declines, he cautions, and he's especially bearish on the outlook for the rental segment.
Yeah, look, well, Canadian housing starts for low-rise homes and condo buildings have slumped to their lowest levels in 16 years, all the way back till 2010. Starts for purpose-built rentals, PBRs, have accelerated with the aid, of course, from CMHC and a lot of the business that we're seeing, Dan, through, of course, as you mentioned, the MLS Select product, which really is kind of the major incentive we see to get some of this stuff done, at least from a financial product, and it really makes these projects viable in a lot of cases. Now, again, there's obviously cautions and dangers there not to abuse that, where we've seen a lot of abuse on the MLI Select product, but that's a whole different story. Look, meanwhile, buyers who purchase condo units in the pre-construction market, remember that market? That was a hell of a time back then. A lot of those people who purchased years ago are now having trouble closing as those projects begin to reach completion, and more and more deposits and actual closing on these units has to happen. Many purchased those when mortgage rates were hovering around 1.75%. Again, we're not likely to see that for a long time, and today they face rates in and around the high threes to mid fours. There was just way too much exuberance back then. And Danny, you just brought up another point, right? The renewal wall that these people are hitting. We're seeing 2 to 3 more full points on a mortgage. Well, that can erode or completely erase any cash flow you would have seen on that pre-construction condo you bought.
Yeah. Also, buyers could, in the past, flip the contract in the assignment market or sell at completion. To do so now, those buyers would take a hefty equity loss. And so the only choice left is to rent, says Mr. Kavcic. And that reinforces his concern about the rental market, because you're going to see more landlords bring these properties onto the market as rentals, even if they hadn't really intended to even own these at the beginning when they first made the commitment, right?
And let's be clear, these are like brand new units, right? So that'll be an interesting addition to what we're seeing. That's already with vacancy already up. It'll be interesting to see what a new batch of new units does to the market. And look, meanwhile, demand has weakened with the dramatic drop in population growth, and we're seeing that have an impact on rents that are decreasing across the country. Against that backdrop, Kavcic sees no reason for investors to return, or at the very least return quickly. The incentive isn't there anymore. The real estate market is dead money, he says, noting that, of course, equities and other markets have been on a tear. Now, that's pretty harsh, but I think to paint it with a broad stroke, that probably resonates for a lot of people. Now, Dan, you and I are both working with a lot of investors and builders and developers that are still getting a bunch of great deals done. I just think it's not the market it used to be, and you really have to, you got to be a great operator. You got to not only find a good deal, you got to make it better. The days of just buying whatever you want and it appreciating are long gone.
Yeah, and they interviewed a couple of realtors in the article here, and obviously we're seeing the impact of stocks versus real estate on our show, and content and the world that we're in, coaching. People are not super happy about the asset class, so they're not really pursuing it that aggressively. But I found it kind of interesting, right? Because you're starting to see even homeowners pulling their listings off and maybe trying to relist in the spring. And so it makes you wonder if there's more pent-up supply coming in the spring than this pent-up demand we've been hearing about. And they interviewed a couple of realtors. This one said, just because a home was worth something 3 years ago doesn't mean it was worth that today, one of the realtors said. I think a lot of agents are also watching to see how much supply arrives in the resale market. And a lot of people are hearing from baby boomers who are holding onto their large homes with hopes of recovery in prices, but have now decided to move ahead with a sale. Almost a quarter of the Canadian population are baby boomers, and most of them own their homes mortgage free. I think over 60% of single family residential homes are owned by that cohort. And so that's a big trend that could, be sitting on the horizon as well. And some of the homeowners with high-priced properties are also choosing to downsize their investment as economic uncertainty continues.
Yeah, Kavcic kind of finishes up and says that he does not see a significant bounce in home prices without a meaningful reduction in interest rates and a sound economy. Well, Dan, we just covered interest rates, and it looks like they're not really going to significantly change at least for the first few quarters of this year. And, I don't think we can call 25 basis points up or down a significant change. So I don't know how long that's going to take. And a sound economy,
Yeah, don't see one of those anytime soon.
Yeah, I'd love to experience a sound economy. And look, those two things together, they don't really happen that often. The fastest path to rate cuts is actually a poor economy and mounting job losses, which of course does not create a healthy scenario for the housing market. But Kavcic also adds that sellers and buyers will continue to trade even if prices move sideways for a while. Yeah, you know what? That's because real estate at the end of the day is shelter, and people need to move for whatever reason is upsizing, downsizing, starting a family, getting a job. Like, people will move. We're just going to see probably the cohort of people actually making moves are people that are actually needing or wanting to do that, more so than just people moving for the sake of trying to make money. You can only wait so long, he says, though, to sellers. There's a cost to waiting as well. The attitude among buyers at the moment appears to be reverse FOMO, fear of missing out. If you're going to stick your neck out now and get into a property, you'd better really like it. Well, I completely agree, and I think we've said that for years, Dan. This is a major decision, whether it's a buy, a sell, or an investment property. Do your due diligence, have the right power team. And again, you better really know it, and you better really like it. So on that note, Dan, why don't we bring in Rob so we can hear it from the man himself and hit him with some of these kind of questions that can really illuminate more from what he's said here.
All right, Rob, could you start us off with just a quick little background? Who are you? What do you do? And what's your interest in the housing market right now?
Sure. So, senior economist, Bank of Montreal. I cover Canada, cover financial markets in Canada, the economic outlook, and the real estate outlook in Canada as well. So that's kind of my background, and I, came from the Bank of Canada to Bay Street, and that's where I've spent most of my time. So, pretty keen interest on housing. My father was actually a builder growing up, so I spent a lot of time in and around the industry.
Cool.
So, same thing, just taking a different approach, obviously, now than out there, actually.
Yeah. So you mentioned, and I think you were quoted in an article with the Globe and Mail, and we put your analysis on the show on a monthly basis when you guys do the Canadian Real Estate Association stats. But in this Globe and Mail article, you mentioned this sort of slow grind forecast where you've been talking about this for a long time. A couple of times we've had you on the show. What made you confident that it would take years and not months to unwind the real estate cycle that we're going through in Canada?
Yeah, so that was the call we made back right at the start of 2022. And it was maybe a bit of a contrarian one at the time because the market was just running so hard. And the basis of that call was, there's a lot to talk about here, but probably put it most simply, like every positive factor that can drive house prices higher was coming together at that one time through 2021 into 2022. And then when we looked ahead, we said, okay, well, we know this can't continue, first of all. So this has to be somewhere around the plateau. But probably even worse than that is a lot of those factors are actually going to start to reverse and go the other way, right? So things like the demographic flows, whether it's millennials here or immigration flows, deeply negative real interest rates that we had at the time, the speculative psychology, all of that. So when every positive factor is in place at one time, pushing house prices higher, and the valuations of those house prices at that moment is stretched relative to incomes and interest rate fundamentals, there's not a whole lot of room to go anywhere but sideways at best, or probably lower. And that's what we're going through right now. And you can look back through various cycles. This does not take place over months or quarters. This always takes place over years, right? So that's where we are.
Yeah.
I mean,
sure.
It's kind of like the perfect storm, right? And of course, it took years to get there. So, inevitably it'll take years to get out of it. And Rob, we were making similar calls, probably influenced by your great work at BMO. We were making similar calls on the show back then, and it was not popular. People did not want to hear that. Hey, the party's about to end. Someone called the cops. It's time to get out of here, kind of thing, right? It was because a lot of the industry. I'm not going to point any fingers or name any names, but a lot of the industry was saying quite the opposite back then. And I think we're kind of in that rude awakening part here, where the years of craziness and frothiness have come to an end, and now it's going to be kind of years of the other side of things.
Yeah, totally agree. And it's the process of getting back to the market just running off of those underlying fundamentals, right? And I always think of underlying fundamentals as incomes, interest rates, and rents, demographic demand. And it's easy to get away from that when prices are running 20, 30% per year and you have investors out there, snapping up properties simply because prices are rising, not because of cash flow fundamentals. And you have buyers maybe like pulling demand forward because they're afraid of missing out in the real estate cycle and going through their middle years never having home ownership. But that
Yeah.
psychology is all changed right now, right? So we're going back to pricing everything off of those fundamentals. And when things start from a level that's so stretched, it just takes time to get there. And that's why this is playing out over years. We just need more time.
Yeah, probably not what a lot of people want to hear right now. But Rob, you mentioned a key word there, and that's investors. And I want to kind of take a little journey through the last couple of years as a real estate investor. Let's go back to 2022 when anybody and everybody could have been a real estate investor. You bought pre-construction and with the intent of assigning it. You were buying single family homes and painting them and being able to flip them for $100,000. You were buying properties and putting a basement suite in, and all of a sudden your equity had increased by the hundreds of thousands of dollars. As you said, the fundamentals never added up and never really supported that. But of course, speculation, greed, and probably a couple other factors led to that. But in this article, I think you said some pretty important stuff, saying that right now investors have very little incentive to return to the market. Explain that to me, and then what do you think would bring them back eventually?
Eventually they will come back. But right now, if you're an investor standing there, let's say with a pile of liquidity, and you're asking yourself, where am I going to put this? Am I going to put it in a market for, let's say, a cap rate or a rate of return somewhere in, let's say, like the 4.5% range? And am I getting a lot of risk with that? Prices are falling in that market. Liquidity is exceptionally low. Transaction costs are exceptionally high. There's risk of getting a crappy tenant and not being paid. Am I going to take on that when I have alternatives out there like risk-free government bonds that are going to pay me 3.5% every month for the year, but pay me every month without question? It's not enough of a premium, right? Or I can look at something like the equity market where I can go pick up dividend yields at 3.5%, 4%, 5%, 6% in some sectors. I'm going to get paid every quarter. Those dividends are rising faster than inflation and they're taxed more favorably. Yeah, again, that cash flow trade-off, I'm probably not buying the first thing, which is obviously, investment real estate right now. That's what we're talking about.
Yeah.
So unless there's something to offset that, and that's something through that boom period was prices running at 20% because if things went against me, well, I could always just flip the property and take the equity gain, right? That's not happening now. So the incentive to go there is just not in place. And you got to think like investors out there right now, just watching what's happening in the equity market. But put it this way, I used to, we do presentations all the time across various lines of the bank and across different client groups. For years, the question was always, should I invest in real estate? Should I invest in real estate? Nobody asks about that anymore. They're asking about, is the stock market strong enough to keep investing in? Should I be investing in gold or other asset classes? So the psychology is totally pivoted away.
Yeah. Well, gold and silver have seen a little bit of volatility in the last couple of days as well, time stamping this on January 30th, where we saw a crazy swings in those markets as well. I just want to jump in here and just play devil's advocate for fun here, Rob. Dan and I speak to investors on a daily basis from across the country. It's what we do. I'm talking to a lot of what I would consider the real deal investors, right? People that do this day in and day out, whether they are portfolio builders or developers or a series of different things all under that umbrella of real estate professional services or investing. And a lot of the, what I would say the real movers and shakers are saying that now, actually based off of all the negative sentiment around real estate and all the, more mom and pop investors or speculators kind of sitting on those sidelines, that now actually is a good time to invest because there is a lot less just overall action in the market. People are finding better deals. There's lack of interest in a bit more of the high riskier stuff. And so if you are a good operator and have that correct power team and all that stuff in play, I'm hearing and seeing anecdotally from a lot of my clients and friends in the industry that they are seeing a lot of activity. Of course, that activity is much smaller on a scale because we don't have the tons of, let's say citizen style investors. But I would love to hear your thoughts on that. Do you think for, actual operators and professionals in this space, now is a good time before we get back to the more fundamentally supported real estate market that would allow a lot of more people to come back in?
Yeah, that's a fair distinction. It's an important one too, right? It's a big distinction between a legitimate institutional type investor or career investor that knows what they're doing versus, somebody with moderate income going out there and buying 3 pre-construction contracts. It's very, very different. So to your question, I think it's a lot safer to go back out into the water right now, just given that the vast majority of that adjustment, whether it's froth or valuations, has worked itself out. There's a big difference between that and having the market actually start to turn significantly higher again, which I don't think is going to happen. But I think from the perspective of, is it safe to actually get out there? You're even if you're 80-90% of the way to where we need to be, the fact is that at this point you've probably bypassed the worst of the correction. And that's the perspective investor. It's even a perspective of a home buyer, right? That was sitting there worried about missing out in 2021, and now giving personal advice at the time, late 21, early 22. Just do not buy a crappy property right now because you're going to get stuck with it, right?
Yeah.
Don't stretch into a crappy property at this exact moment. You're going to regret that for 10 years. Now, I would say it's a lot safer. And if you have a longer time horizon and you have liquidity, honestly,
I think, it's interesting you mentioned like during the investor period of time that like they had that something else, right? Like yields were never really exceptionally good, maybe in the last decade, especially in the single family market. And maybe they won't be, who knows? But there are still investors in the trades like CMHC's MLI Select program, building multifamily housing through getting an extended amortization, and that's kind of that's the extra that's still compelling people to play in that space. And that sort of leads me to the next question, which is on rentals, because you mentioned that you were sort of pretty bearish on rentals, and I don't know if that means rents or yields or whatever it is, but we know that we've got from CMHC data a record number of rental units under construction. Most of those are financed and insured by CMHC through either MLI Select or ACLP or whatever. And we have a lot of supply delivering from the condo side of things. There's a lot of converging forces from my view that are happening. I'm curious to get an understanding for why you have this sort of negative take towards the rental setup and because especially we're speaking mostly to an audience of investors, like what makes you feel that way and sort of what would change your mind?
Yeah, you summarized it pretty well. So the supply side of the equation is chock full of product, right? Coming through the pipeline and coming to market, especially if you're drilling down to like the smaller 1-bedroom type stuff in the major cities. So it's funny, ordinarily this moment in the cycle, you would actually see residential construction backing off quite a bit because resale demand has fallen off so much. But you haven't, because the purpose-built side of the market has backfilled what we've kind of lost on the ownership side, right? So those housing start numbers are actually holding up, and the under construction numbers are holding up relatively well. So there's a ton of purpose-built rental supply coming, as you mentioned, partly prompted by government incentives. And at the same time, a lot of that investor boom, which, let's say somebody who did have pre-construction investment back in 2021 coming to completion now and coming to closing, and you can't sell that place without taking a big equity loss. Well, they flip that on the rental market too, right, to maybe buy themselves some time. So you're not only the purpose-built supply, but you also have that competing with the private condo ownership side of the market that's adding more and more rental supply. And the kicker in all of this is that we always kind of say supply takes years, demand takes minutes to change. And with the stroke of a pen, Ottawa took us from 3.5% population growth down to 0 overnight. So in a sense, the market from a supply side has been chasing population growth higher, couldn't keep up. And now bang, population growth has been capped to zero. All that supply still has to come to completion, but it's going to come to completion at a time when the demand curve has completely flattened out. So you already see it on the ground. You guys know probably even better than I do when I look at the data. The minute those caps were put in place, rents peaked and started to fall across the major cities. And again, these things take a lot of time to play out because real estate's slow and cyclical. So this is probably, third or fourth inning of this playing out.
Yeah, that's my view as well.
Are we talking like Jay's
Too
World
soon for
Series
baseball,
style innings, or like how many innings are left, Rob?
Well, not halfway. I'll put it that way.
Okay, good to know. Look, I think there's three I words, right? Immigration, inflation, and interest rates that really have had a major impact on swinging the Canadian real estate market one way or another, for better or for worse. You just touched on immigration. We've kind of been covering inflation recently on the show. And of course, both of those impact the Bank of Canada's interest rate decisions, which we just saw a hold just a couple days ago. Next announcement's about a month and a half out. We've looked at the big six kind of predictions for this. Obviously, we're not in the prediction game here, Rob. We've all been doing this long enough to know that that's not a fun game to play, especially with political and socioeconomic volatility that we're seeing in the world right now. But I want to talk to you about interest rates, regardless of all that. You noted that we either need to see interest rate cuts or a good economy, or interest rate increases or a good economy. Well, the likelihood of seeing a really good economy in Canada, I think, is another very long-term play. But talk to me about your thoughts on where interest rates are going to go, knowing that both kind of BMO and all of the big banks have really kind of put it, there's not really much going to be happening, at least for the first couple quarters, maybe Q3, Q4 this year, 2026, we start to see maybe some movement up or down. 27, maybe a bit more real impactful movement on an interest rate side of things. Talk to me about your perspective on where these are going to go, and if there is something, if there is that moment in time where we see something big enough happen that it justifies another cut or potentially a hike. Just talk to me about your perspective on that.
Yeah, so this is important because when we're talking about this market actually finding a floor and turning around, the fastest way you could do that would be to bring interest rates down, right? And we do some of the arithmetic on, let's say, affordability or the investment like cash flow calculus. If you were to get mortgage rates down to like 3% or maybe a touch below, I think a lot of it would start to make a lot more sense really quickly, and you would see the market start to fire up. But we just, the reason we have this long playing out thesis is we just don't think we're getting there. You can have the Bank of Canada cut rates another 100 basis points really quickly if we have the trade war blow up and we go into recession, but that's not going to help real estate, right? Real estate doesn't rally through a recession even as interest rates are falling. It rallies out the other side. So we're not forecasting that. You don't want to see that anyway. Look, this is actually a pretty straightforward answer because interest rates are, to really make it simple, interest rates are going where they are right now. And I mean two things in saying that. Number one is the Bank of Canada has told us, the forecasters and the market, as clearly as they're ever going to tell us that they're happy with rates where they are. And it's going to take something significant for them to move off of that stance, right? So we have 1.5% growth in our forecast through 2026. We have inflation kind of sitting around 2.25%, 2.5%. In that environment, the bank is just kind of sit there at 2.25 and not do anything. So those variable rates won't be moving unless something changes there. And then the other reason I say that is if you think bigger picture and you step back and say, okay, well, where are neutral interest rates in this economy? What should I plan for? Not over the next 6 months, 12 months, but over the next 2 years, 4 years, 6 years, maybe even out to 10 years. You should probably plan for interest rates that are very close to what you see out there in the market today. I say that because from a fundamental perspective, this is a very neutral interest rate environment. So, 3.5 or so on the 10-year, GIC yields you see when you walk into the bank, 3.75 to like 4.25 for mortgage rates. That's all very, very neutral and probably what you want to budget for. So, I mean, that's where we are. What would move us off of that? You could have the economy really like deteriorate through the first half if, let's say, USMCA negotiations break down and capital spending really retrenches in. That could prompt some more easing, but again, we don't want that outcome. The flip side is, look, we actually get a trade deal. You have a big CapEx boom in the US and a productivity boom in the US that's driving pretty much 3% economic growth. If some of the uncertainty in Canada clears up, that could actually accelerate growth in Canada. And in the second half of the year, you could have the Bank of Canada reasonably talking about maybe ratcheting rates up 25 or 50 basis points. We're not there yet, but it's certainly possible.
So nothing's off the table at this point is what I'm hearing, at least for Q3, Q4 of this year. It's kind of all remains to be seen. There's so much volatility in the market right now.
Yeah, nothing's ever off the table. Obviously, you guys know markets move really quick and the economic data can swing really quickly. But the two big messages would be that we're very close to neutral right now from longer term planning perspectives. And even in the short run, the Bank of Canada is rarely ever this clear that they're happy leaving rates where they are.
Yeah. Yeah. I mean, he said it multiple times, right? He said, like, I feel like we're at the right spot right now. It's interesting because I think a lot of people thought there was a lot more downside potential in rates, and that, maybe we get a little bit more of an optimistic recovery. But I think like the market needs to settle into the new credit environment, it would seem, and then we start rebuilding maybe on more responsible borrowing terms, perhaps for borrowers. I guess that maybe leads me to, next year and sort of like forecasting. There's a lot of optimism in the real estate industry that we maybe see some strength in the spring market. Even the Bank of Canada mentioned a pent up demand in their monetary policy report. But I'm of the opinion that there's maybe just as much pent up supply as pent up demand that we could see at least in 2026. Any thoughts on sort of like that? What spring market 2026 will bring us, and sort of the HABO, like happy about missing out phenomena with buyers that we're seeing in the coming year?
I would agree with you. You always hear about pent up demand because sales have been so sluggish, but I personally see a lot of listings just go unsold and canceled and pulled, and a lot of people kind of just saying, well, hell, we'll come back in the spring when the market's better. So if I'm going to make a guess on this, like assuming our economic outlook holds up and we don't see something totally go off the rails, I think both of those factors are going to come out in the spring, and they're going to kind of play to a draw. So you're going to get better sales volumes, but you're not going to get a whole lot of movement in prices. And so I've kind of always argued that there has been a big bid-ask spread out there in the market, right, so to speak, where sellers have been really slow to relent because they don't really have to. They don't have to sell. There's no like job stress. There's no liquidity pressure or anything like that. It's not 2010 when there was a ton of forced selling across the U.S. economy. That's a very different response, right? And then on the flip side, the buyers are there. There is fundamental demographic demand, especially in that millennial group for single detached housing. But like you just physically can't walk into a bank and qualify at prices that existed 18 months ago, or you can't make the monthly payment. So that spread is really wide. And I think as we go through the spring, because rates have come down, incomes have grown, sellers relent a little bit, you do get more volumes, but price levels more or less just kind of go sideways.
Yeah. Rob, I don't want to take up too much more of your time. I know you've got to get back to the bank and do a bunch of analyzing today. So one final question for me before we let you get out of here. If you could just leave our listeners with, kind of the different cohorts, right? And maybe anyone trying to buy a property in, either the next couple months or planning to this year, anyone trying to sell a property. And then, of course, maybe speak to those potential investors, maybe not at that institutional or professional level yet, but those people, because, I still think the desire for Canadians to invest in real estate is really strong. It's just not being acted upon right now. So if you had to leave one piece of, high level advice to buyers, sellers, and investors for at least the first half of 2026, what would it be?
So it's a good question. For buyers, there is probably a 2-year period there where I was saying just be patient, do not touch, do not rush into the market. And that has proven to be correct. Okay, so I would say now that if you've been sitting there for 1 or 2 or 3 years and you like legitimately have a family you need to put in a house or something like that with a backyard, um, it's a lot safer now, right? From a longer term perspective, it's a lot safer. And like, as I said, even if we're 80, 90% of the way there, you've avoided the vast majority of the damage to this point. And real estate is, and I don't want to like sound like a big bear here because I've been super bullish on real estate for probably like 15 years, and that all changed around 2021. There is still a really strong long term case for real estate in Canada, especially for single detached around the big cities. So I would honestly say, like, if you can afford it, you can handle the monthly payments, you don't need prices to rise in the next 3 to 5 years, go ahead. Yeah, it's a lot safer now.
I like that. I just want to
I
pause
think if
you
you can
there for a
handle
second.
the risk too, right? Like if you're comfortable with there being a bit more downside risk and maybe not capturing the best rate.
Yeah. I think that's the important piece, right? If you're not relying on prices going up, if this is a place to live and you're okay with, my house is worth $100,000 less next year than I bought it for, but in 5 years it'll be up 150 grand, and you're not even planning on selling. So I think that's the real key piece there.
What I was really worried about, like, given that question the last couple of years, was you have a family or like a young couple really stretch into a crappy property because the market was so stretched, and then let's say life circumstances change. Well, now you're trapped there, right? You have a 20% equity loss and you're trapped. You can't sell it. You can't move. I think
there's unfortunate situations. And
I think most of that risk is gone now. So
for
financially,
sellers,
maybe it's not the best investment at this point, but for sellers, this isn't really my area of expertise, to be honest. I would imagine quality single attached properties around the big cities are probably going to start moving if the price is right. And sellers probably just got to realize that 18 months ago doesn't exist anymore. And if they actually want this place to move, you got to just be respectful of where market conditions are. And in a lot of cases, that's just kind of swallowing your pride and saying, this is what market prices are today. It's not what they were 18 months ago or 2 years ago, or what my neighbor got in, February of 2022 doesn't exist anymore.
Yeah. Time to live in reality, unfortunately, for some of those people. Okay. Final one, Rob, advice for, let's say, the newer investor, or that investor that has one or two properties, maybe looking to scale, or maybe thinking of getting, off of those proverbial sidelines and back into the market. Speak to those people.
I think from the investor perspective, we have to get away from this notion that real estate is just, a leveraged bet on rising prices. I think that environment is over. And we have to start thinking about it more of what we always have traditionally, which is a cash flow investment with obviously like long-term benefits of, let's say, increasing scarcity in single attached, or inflation protection, because real estate over time is traditionally a pretty good inflation hedge as well. A real physical asset in an environment where maybe, there's some currency debasement and stuff like that. There's a lot of value fundamentally in real estate, but so the advice would be just keeping all that in mind. We have to think about these things from a cash flow perspective rather than the expectation of just prices jumping over the next couple of years and flipping that place. And like, if an investor can find quality property with cash flow fundamentals that make sense, given all the inherent risks in real estate that people seem to have forgot about for a couple of years, like tenant risk and liquidity risk and all that type of stuff, then sure, again, the advice would be pretty similar. We're most of the way there. We're not going to see the market snap back. You're not going to see quick gains, but we're most of the way there. If you find quality product, it's probably a lot safer to get into the market now than it was.
Yeah, love it. Wise words from a wise man. Rob, thanks so much for joining us again today, sharing your thoughts and insights, which are super valuable as always, and for being a repeat guest on the show. Really appreciate you and your time today. And thanks everyone for listening. We'll see you on the next one.